Hello, Lake County, Florida, and welcome to Around the House, sponsored by Romac Lumber and Supply. I'm your host, Don Magruder, and you're listening to my 790 AM WLBE in beautiful Leesburg, Florida. And if you're seeing us, you're watching us on LSTV, Lake Sumter Television, and Appleseed Marketing. Since the beginning of the Great Recession, many potential home buyers, remodelers, and contractors have faced problems with financing and miles of new government tape. Many contend the reason why America's economy and housing has not rebounded as strongly as it should have is because ordinary people still cannot get loans. Recently, the head of the Federal Reserve, Janet Yellen, cited tight lending for continued sluggishness in the housing market and the nation's economy as a whole. So today's topic is home financing. Whether financing a new mortgage, refinancing an existing home, or a loan for a remodel, secure money is more difficult after the housing bust. Plus, what about reverse mortgages? Many seniors in the area are tempted by the advertisements, but do reverse mortgages actually work? A lot of mystery with that one. To answer many of these questions, we have a very special guest today who is an expert in home financing. Today our guest is Dave Van Winkle, the first vice president for Citizens First Bank, and he really is an expert when it comes to home financing. Citizens First Bank is a very strong local community bank with offices both in Lake and Sumter counties, and the bank has a reputation for old-fashioned hometown customer service. In fact, the motto of Citizens Bank is hometown banking at its best. So with that, I'd like to introduce Dave Van Winkle of Citizens First Bank. Good afternoon, Dave. How are you doing?
Don, I'm doing great. It's great to be with you on your program today and look forward to talking about refinancing, mortgages, construction loans, and reverse mortgages, and try to give the listening audience an insight into what's going on in the mortgage world today.
And Dave, as you know, you see it every day. It's very confusing. I've never seen the complexity in getting home loans and home financing like we do today. Is that sort of where your stance is?
Yes, all the regulations have changed the landscape substantially. Loan files that used to be on a conventional loan, say an inch thick or inch and a half thick, now it's not uncommon for them to be 4 inches thick.
That's amazing. Dave, before we get too deep in our conversation, tell our listeners a little bit about Citizens First Bank, a little history, where your locations are, and the services you guys offer.
First of all, we are a full-service bank, and we are right here in Lake and Sumter County. We do have one branch that's in Marion County up on 42. We do commercial lending as well as your standard array of retail products for checking, savings, CDs, etc. And we also offer a complete consumer division, car loans, boat loans, and RVs, etc. And we, of course, offer regular real estate mortgages as well. We have 8 locations in the villages, and we have 1 location in Leesburg. The one in Leesburg is at the corner of Griffin Road and 441.
And from what I've read, you're one of the strongest community banks here in Central Florida. Is that a fair statement, you think?
I think so.
Okay. You've talked about the problem with lending. The most common question or phrase I hear all the time, banks aren't lending. Let's ask the first question, is Citizens First Bank lending?
Yes, we are, Don. We have a full pipeline right now. We're scrambling to stay on top of our loans that are in the pipeline right now. There are people who are searching for the path of least resistance. When I say that, I'm referring to they're looking for lenders that can get it done the easiest and the quickest for them. And of course, being able to get the deal done at all is another plus in all that equation as well. But yes, we are still lending. We're still doing construction loans. We're still doing a lot of home equity lines of credit every single month. We're doing some refinances. Now, the lower rates and beginning to rise here in the last 3 months or so, has changed the refinance market. You're not seeing nearly the refis that you did, but there's a lot of purchase deals that are coming in, and we are doing our share of purchase lending.
And that's great to hear, but I think you said something key. The people are searching for folks who can get them through the wilderness. And whether it's home financing or home construction or even maintenance, it's real easy to put up a lot of roadblocks. So if you can get them through the process, that's a big deal, isn't it?
Very much so. And we've been at this for quite some time, so we're not newbies in that sense, and so we know the ropes and we know how to get people through that. I myself find that whenever a reg is rolled out, it can be very confusing, even to a seasoned lender, to understand exactly how that regulation is interpreted and how it is implemented.
Now, are you guys doing construction to permanent financing?
We sure are, Don.
In fact, that hardly nobody was doing it a few years ago.
Right. We never stopped.
You never stopped.
Never stopped. But what I'm seeing today is construction to perm business is increasing pretty drastically. That's a good statement right there. We're encouraged about that. What's happening right now, probably 25 to 30% of our active loans that are in the pipeline right now are construction to perm loans.
Let's talk about specific lending. If a customer is interested in building a new home, what's the process they're going to have to go through to secure that loan? We talked about, I know you can't go through every integral step, but give us the basic horizon they're looking at.
I think, Don, the very starting point would be to let us do a pre-qualification for you. Find out what you can afford.
Okay.
Based upon your income, your credit, etc. And usually that can be taken care of over the phone. That doesn't require a face-to-face visit.
Is there any charge for a pre-qualification?
None whatsoever.
Okay.
None whatsoever. If you've got more intricate questions, details, you're looking for a lot of detail, maybe a face-to-face meeting might be better for that.
Okay.
But then after the pre-qualification is over and you've been told by us that, okay, we can loan you X number of dollars, then you need to seek out and find your lender, your builder. Okay. And find your builder and start working on your plans. And if you haven't acquired a lot yet, obviously you've got to get that nailed down, and the site, and make sure you know what your costs are going to be to prepare that site so that you can erect a structure on it. And then once you get the deal together with your builder, plans are in place, and a contract has been signed with the builder, now you're ready to apply for a loan.
Okay. There's several types of qualification letters. Do you offer multiple qualification letters? I've been told there's a initial qualification, and then there's a hard, fast. This is how much the loan's good for. Say if someone's wanting to buy an existing home, do you offer those type of letters too, Dave?
Initially we only offer the pre-qual approval letter.
Okay.
And then on down the road, lenders used to make what was called a commitment letter. However, those are very difficult to come by today, and most lenders do not do that anymore.
Okay. If a customer, you talked about selecting a builder, they find the builder, how much detail, I guess first off to get a pre-qualification letter, how much detail is the potential homeowner going to need to bring to you?
For the pre-qual, all they're going to need to bring me is personal information, name, date of birth, social security number, and current address, and income numbers. That's not a verifiable income. They tell us what they earn, and that would be gross income. That's not net. And then we do a debt-to-income analysis, look at the credit, and then say, this is what we think we can do for you.
And isn't debt to income somewhere around 43 now, 43%?
It depends on the product, okay? For example, if somebody wanted a product that was held within our bank, then the ratios are going to be a little bit tighter on that. It's going to be 28 and 36%.
All right, if they've talked to a builder, or you're going to ask them to bring a full set of plans with detailed list of what's going in the house, In other words, are you going to get an appraisal off the plans and the lots and such as that?
That's correct. And if they've owned the lot for a while, we will go off of the actual value of the lot instead of the acquisition cost. And that makes a difference because it could be that if they bought the lot 3 or 4 years ago or 5 years ago, whatever, there could be some substantial equity which can be used toward the 20% down payment requirement in order to do a construction to perm loan.
That's pretty good. This segment of Around the House is sponsored by the Romac Lumber Design Center. Are you planning a new home? How about a remodel or addition? If so, you want to visit Jeremy and his expert staff of draftsmen to help you plan your next project. The Romac Lumber Design Center offers custom plans and drawings ready for permitting for most residential projects, and what makes them a cut above others is they have the products you need right there so you can pick them out. They can be incorporated in your plan, so it allows you to have fewer mistakes, a better quality plan, and most importantly, you can get an accurate price to quote. From doors to windows, garage doors, and sign trim, you can come pick your product specifications and have them incorporated in. For more information on the Romac Lumber Design Center, call 352-787-4545 for your drawings, blueprints, plans, and for your next project. That's 352-787-4545 and ask for the Romac Lumber Design Center or stop at 700 East Main Street in Leesburg. We're talking about plans, they can draw them up for you. Let's talk about the different type of financing, Dave. Conventional financing. What's meant by conventional financing?
Conventional financing would be what we would call a regular loan, standard amortization, 15 years, 20 years, 30 years, with a loan amount less than $417,000. That would be a conventional loan.
An FHA loan or VA loan?
FHA and a VA both are government guaranteed loans. You can get 100% a loan amount on a VA loan. There is a funding fee associated with a VA loan, and it depends upon how many times you've used that VA as to what the funding fee is. If you're a reuser, for example, it could be as high as 3.3%. But there is no monthly mortgage insurance on a VA loan.
Which is a big deal.
It's a big deal. It lowers your payment, plus you find that it's just a great deal and a good way for our customers to be able to take advantage of a wonderful product for our veterans. We love our veterans and love to take care of them.
And I understand you handle both FHA and VA.
We do. As a matter of fact, on our VA loan, we have a little special tidbit of information I'd like to share with our listeners today, and that is there are 3 things that a veteran cannot pay for as it relates to the loan process.
Okay.
He cannot pay for a loan admin fee, he cannot pay for a termite inspection, he cannot pay for a tax service fee. We issue, as a lender, a $1,000 credit back to the vet that is reflected on the closing statement to cover those 3 costs.
Now, is that just for your bank or all lending institutions?
No, I can't speak for anybody else.
Okay, so that's just something that Citizen does. And once again, they get a $1,000 credit towards what again, Dave?
Toward their closing cost.
That's amazing. Now, one thing that you guys understand you don't do is USDA loans, but it's a big deal around. There's some institutions, I know there's many areas here in Lake and Sumter County that can qualify for USDA loans. You want to give a brief description of that, Dave?
It's my understanding that they're 100% financing, and there is a funding fee on USDA as well. I also understand that there's a specific bucket of funds that have been available, and that is allocated by Congress. So the availability or ability to do one of those is limited based upon the funding that Congress provides. One of the things that we didn't talk much about, Don, we probably need to go back and touch on FHA.
Okay.
FHA is it's a great product. 3.5% down would be the minimum down payment requirement. It does have a funding fee as well. Depends on how much you put down as to what that funding fee is. Okay. Typically 1.75% up to maybe 2.2%. And it also has monthly mortgage insurance. But one of the advantages, if you have hit a rough patch credit-wise,
okay,
If you've gone through a short sale or a foreclosure or even a bankruptcy, the waiting requirement for VA and FHA since that event took place is shorter than if you try to go conventional.
That's amazing. And I understand there's a lot of rules coming up. We're going to talk a little bit about that later. By the way, you're listening to Around the House, sponsored by Romac Lumber. We're having a great discussion with Dave Van Winkle. He's the first vice president with Citizens First Bank right here in Lake and Sumter counties. We're talking about home mortgages and financing, which is a big deal these days. And I know there's a lot of questions out there. Dave, I know you can't get into exact rate quoting on interest rates, but interest rates have gone up a little bit. But in a general range, what are interest rates for 15 and 30-year fixed loans going for these days?
Well, let me say this, Don. There's never been a better time to buy that as far as rate motivation. Right. 15-year fixed right now, they're running anywhere from 3.25, 3.5, depending on your credit score. And a 30-year is running 4% to 4.375.
And you know, it's amazing. Historically, people talk about rates going up. Historically, those rates are extremely low.
They are.
We're going to take our first break, but we've got a lot more to discuss with Dave Van Winkle from Citizens First Bank. Stay tuned because we've got a lot more to talk about. Welcome back to Around the House, sponsored by Romac Lumber. I'm your host, Don Magruder, and you're listening to my 790 AM WLBE in Leesburg, Florida. And if you're watching us today on LSTV, Lake Sumter Television, courtesy of Appleseed Marketing. And we hope you're enjoying the program. Our guest today is Dave Van Winkle. He's the first vice president of Citizens First Bank right here in Lake and Sumter counties, and we're talking about home financing, home mortgages, and we've got a lot to cover. And one thing we found out is that Citizens First is lending, and it looks like things are improving on that part. But right before the break, Dave, we were talking about interest rates, and sort of join our get our conversation going again. Won't you reiterate what, in general, the rates for 15 and 30-year fixed are going for these days?
Yeah, a range on both of those, Don, would be for a 15-year fixed 3.25 to 3.5, and on a 30-year fixed, you could expect an interest rate of 4% to 4.375. The reason for the variance there is something called risk-based pricing. In other words, the better the credit that you have, then the better the rate you're going to get. And so we have to price that, especially on our secondary market loans. That would be loans that we originate and we sell on the secondary market.
And I guess we need to make a disclaimer right now. The things that we're discussing today are just for informational purposes only. It may or may not apply to your specific case. That includes credit scores and rates and all that. So please don't hold Dave's feet to the fire. But in general, what type of credit score, minimum credit score, is required to qualify for a loan in general?
I'd like to qualify my response by breaking it down into two categories, Don. Number one, Citizens First Bank, as it relates to its portfolio lending, that's loans that we hold in the bank, does not have a minimum credit score requirement.
Okay.
But I don't want to mislead our listeners and want them to think that you can walk in with a low credit score and be able to get a loan. We do expect you to have good credit, but we also know that there's a variance between how bureaus report your credit. It's not uncommon. I've seen credit reports, for example, from Experian, or the score from Experian be 50 or 60 points difference between that one and perhaps TransUnion.
That's amazing.
And so that's why we don't base our decision strictly off of a credit score. We look at the overall borrower. We look at what they're bringing to the table. We look at their investment. We look at their ability to repay and so forth. So I don't have a number in that category. Secondary market, that's a different story. If you're looking for a long-term fixed rate that we're going to probably sell on the secondary market, then there's a minimum credit score requirement by the wholesaler that we sell to of a 640.
Okay.
And so now there are lenders that are out there that will take a lower credit score than that, but usually what happens is the rate's going to be higher.
And that's something that needs to be pointed out. The more challenging the credit score and more challenging the deal, the higher the rates typically go. Isn't that correct?
Yes, that you're talking about risk-based pricing, and that is true. You know, usually what will happen is, for example, let's just say you've got a borrower and their credit score is somewhere between 660 and 680. Well, there's probably going to be what's called a pricing hit for that borrower because that's not the highest score. That's not in the what we would call the really high score range. And so, yes, their rate would be slightly higher than, say, for example, someone who has a 740 to a 760.
And real quick, the internal down payment requirements through equity or cash down. Once again, you mentioned you may own your lot, and that'd be part of the total down payment situation. For a conventional loan is running what these days, Dave?
20% is a standard loan requirement. Now, if you're doing a purchase, okay, now we can do 10% down with PMI.
So purchase is 10% and a new home is 20%. VA and FHA is what again?
VA and FHA, 100% for VA, 97.5% loan to cost on FHA.
And I understand USDA offers up to 100% financing, don't they?
That's what I'm told.
So there's actually some good deals out there.
There are.
I noticed on your website, and by the way, you have a great website. What's your website address so other people can look at it?
It's www.citizensfb.com.
Anyway, I noticed you had something on your website that I thought had disappeared. You have ARMs listed, and for our viewers and listeners, that's adjustable rate mortgages. And for some reason, I thought ARMs disappeared with the housing bust. And I guess I'm wrong. Explain to me and our viewers about ARMs and the advantages of them.
One of the things that we're finding today, Don, is there's a growing desire to have a local servicer of your mortgage.
Now so let's put it in real terms. In other words, someone at the local bank or local office who actually owns your mortgage, not someone in Sioux Falls, South Dakota, correct?
That's correct.
In other words, if there's a problem, they can call someone here in Lake County instead of South Dakota.
That's
correct.
what
you're talking about, right?
Yeah, that's correct.
I agree. I hear that all the time.
So what that translates to as far as the value of a 5-1 ARM or 3-1 ARM is a lot of borrowers say, listen, I don't want my loan sold. I want it held right here in the bank. And so I'm going to do a construction loan or I'm going to do a purchase transaction, and I want to know that you're going to be the one that is going to service it. So that's why that a lot of the lending, the portfolio lending that we do is so popular today, right there. Is people want to be able to know they can pick up the phone, talk to a live person without going through a selection process in a phone system somewhere, and know that they can get some answers.
Okay, explain to our listeners and viewers what an ARM actually does and how they typically work, Dave.
Okay, let's take a 5-1 ARM, for example.
And what does that 5-1 refer to?
That means that it's fixed for 5 years, and then it adjusts each year thereafter.
Okay.
It always has an index, some type of a margin. And in our case, what would happen is our current 5-1 ARM rate is somewhere around the 4% mark, something like that.
Okay.
And so what happens is at when the loan starts out, it'll whatever the introductory rate is, that's where you begin, and it stays fixed there for 5 years. At the end of 5 years.
So for example, if the rate currently is 4%, for the first 5 years, it will be 4%.
Correct.
Okay.
For 60 months.
For 60 months.
And then at the end of that 60 months, then it's tied to the 1-year treasury. So whatever the 1-year treasury is at that 60 month, plus the margin. The margin is usually 2.875. You add those two together, and that determines your new rate. Now, a little caveat here, there is a cap on those loans, most of them, ours is. We can't go up more than 2 percentage points per year, can't go up more than 6 percentage points over the life of the loan.
Okay, so for example, say in 5 years I do an ARM and treasuries in 5 years are 2.2%, your margin's 2.8, that puts the interest rate at 5%.
Mm-hmm.
So my new interest rate that year would be 5%. How long will it take to pay the loan off?
Well, you determine that by what amortization that you want.
So for example, you can still set up as a 15-year note or a 30-year note, but it's just going to be on that ARM process linked to treasuries.
That's correct.
And you guys hold that paper or that loan inside your office.
That is correct. That is correct.
Not many banks are doing that, are they?
I really don't know what other banks are doing, but I know it's a very popular product for us. That's what I know.
So you're doing a lot of that.
We are.
That is surprising. I hear a lot of people talk about what's going on with Freddie Mac and Fannie Mae and those type of issues. There's been a lot of talk that they've got a new secretary, the Obama administration may have had an epiphany and that they're going to relax the rules to Freddie Mae and Fannie Mac, and those are the secondary mortgages. Can you first tell our listeners what Freddie Mae and Fannie Mac do, why is it important to them, and what do you think about this potential easing of standards?
Well, first of all, both Fannie Mae and Freddie Mac are GSEs. That means government-sponsored enterprise, which means they purchase the loans that we at banks originates and mortgage brokers. And that purchasing is, what they do is they turn around and they securitize them and sell those securities on the open market and recover some of their costs. But the end result is the borrower makes out, because they usually end up with a very low rate compared to if there was not a GSE. And these rates are phenomenally low right now. Another factor in all of this, as we discuss this whole process, is there's been a move by the feds to purchase mortgage-backed securities themselves. What that has done is that has artificially held rates down. Now, I'm told, and everything I'm reading is that they're going to stop doing that probably in 2015, or at least scaling back. And the end result will be that you probably will not see rates as they are today.
So are we potentially looking at a situation where if they're going to ease standards a little bit, and who knows what's going to happen, but say there is an epiphany by Washington, that they realize they got to get housing going, and some people say there's 5-6 years of pent-up housing demand. Are we potentially looking that 2015 could sell a lot more houses, but the rates be a lot higher because the federal government's not buying these mortgage-backed securities through Freddie and Fannie?
I think there is most definitely the possibility that that could happen. What will happen, Don, if rates start to rise, believe it or not, you'll see a lot of what we call fence straddlers, people that have been hoping that they would go lower, they'll suddenly jump into the market. And when they do, then they start making their purchases, then you're going to see that that's going to start decreasing the supply. And when that happens, well, then prices are probably going to go up. But I can tell you that from everything I'm reading, that both Fannie and Freddie both are expressing a desire to stoke the economy via the mortgage industry. And I think it's time for us to do that.
You're listening to Around the House, sponsored by Romac Lumber. I'm your host, Don Magruder, and we're having a wonderful and very informative conversation with Dave Van Winkle. He's the first vice president with Citizens First Bank right here in Lake and Sumter counties, and we're talking about the potential, forward look of the housing market in the next year or so. And one thing I think is real critical, and you alluded to it on some of the VA, but Freddie and Fannie and their lowering standards part they're talking about, and you hate to say lowered standards, but I think there's a realization there a lot of good people were caught up in this housing collapse because of being upside down on mortgages and stuff, and that they're potentially reducing the lead time or the wait time from foreclosures, bankruptcies, and all that to get those people back in the market. Is that the direction you're seeing, and possibly more flexibility on credit scores and such?
That is a direct result, I believe, of the both FHA and the Veterans Administration to try and help people who I would typically classify as both first-time home buyers and people that have hit a rough patch in their home ownership in the past. The wait time since a derogatory, and a derogatory being defined as a short sale, a foreclosure, or a bankruptcy. The wait time between the time that action took place and the date that you can apply for a new mortgage and feel that you can get it approved has been shortened. And that has proved to be a major source of business for us at Citizens First Bank.
You know, Dave, I've talked to people here recently who said, I can't get a home loan because 2 years ago I applied and I got turned down. Year I applied, got turned down. 3 years got applied. Or a year ago my credit score wasn't high enough. Is it fair to say that these changing standards and the difference in the economy now, maybe what you applied for 2 years ago and got turned down, or maybe 3 years ago, you could probably get approved today? Is that a fair statement?
I think, in all fairness, yes, that is an overall accurate statement. But here's what we need to tell our borrowers, because we want them educated.
Yes, sir.
We don't want them going down the path looking for a dream that may end up blowing up on them.
Yeah.
So here's what I would say. Number one, if something happened, BK, foreclosure, or short sale, make sure you restore your credit, okay? Because that's one of the things that underwriters are always going to look for. Number two, make sure that you do have some type of a down payment and that you have strong reserves after closing. If you come in and after closing you've got $174 in the bank, that's not a good sign. So if we're going to have people apply who are going to take advantage of these shorter wait times, they need to make sure that they're doing all they can to make sure they're a good credit risk.
You know, the other thing that's frustrating to everyone, and I really think this is the reason why a lot of people have not applied for loans as much, is the horror of the red tape. And we talked off the air, you basically have to play, I don't want to call it a game, but you have to go through the complete system and be totally willing and prepared to document, fill out all the paperwork, fill it out again, and maybe multiple times to get a loan. And those who have the patience and don't throw their hands up are having success in getting loans, and those who do not want to do that are struggling. Won't you talk a little bit about the documentation issue? Because that seems to me almost as important as the qualification.
I think that's a fair statement as well, Don. Let me make a contrast here. Number one, if you go with a local lender, I'm talking about now going back to the portfolio lender, a bank that holds the note, they're going to have greater control over that process as far as documentation being required. And it's going to be very helpful and make sure that you don't have to go through so many hoops.
Dave, if someone's interested in getting a home loan, what number can they call you at?
352-259-3207.
All right, we're going to take our final break of the hour. When we return, we've got a lot more to talk about, especially reverse mortgages. That's going to be a big topic. See you in a few minutes. Welcome back to Around the House, sponsored by Romac Lumber. I'm your host, Don Magruder, and you're listening to my 790 AM WLBE. And if you're watching us today, you're watching us on LSTV, Lake Sumter Television, courtesy of Appleseed Marketing. And by the way, you can catch Around the House radio show every Monday from noon until 1 p.m. on WLBE. And don't forget to catch the Around the House column where we give weekly insight on home projects and how to get financing every Friday at the Daily Commercial and Wednesday in the South Lake Press. So there's a couple of different ways you can catch us, and be sure to like Romac Lumber on the Facebook page. You can gather all the information. Today's guest is Dave Van Winkle. He's the first vice president of Citizens First Bank, and having a great discussion about home financing, and want to move the conversation to some other areas of financing. First off, Dave, there's a lot of people who are sort of, better choice of words, house trapped. They're underwater financially on the house, can't sell it, but they need a bigger house. And there's a lot of additions and remodels going on now. Do you guys offer financing for additions and remodels? And what's some of the hoops you homeowner would have to go through on those products?
Don, probably the most popular product for something of that nature would be our home equity line of credit, which a lot of banks offer. Home equity line of credit, obviously, typically the way they'll work across the board is the homeowner has the ability to borrow up to about 80% of their equity. Now that 80% would have to include a first mortgage. So let's just say you've got a $200,000 house, 80% is $160,000. You got a $100,000 mortgage, and there's $60,000 that's still available to you. So you could take a home equity line of credit. Citizens First Bank will make those loans, and we'll actually pay your closing costs for you.
Okay.
As long as you'll keep that line of credit open for 3 years. It has a prepayment penalty of those closing costs for 3 years. And the rate is good, it's tied to prime, you know. So you can take those funds and do that addition, that remodel that you've been talking about, and it's a great way of doing it. We do them all the time.
So for example, if someone wanted to add a pool to the house or do something like that, you could do a home equity line and they could add a pool.
That's exactly right. Or maybe redo the kitchen. A lot of people are doing that today, or maybe even put a room addition on. All kinds of options out there. You're in the driver's seat as a borrower.
And those are loans that are held at your bank, at Citizens First Bank?
They are.
So they would be dealing with someone right here in Lake and Sumter County?
That is correct.
Very, very hard to apply for one?
No, it's a one-page application, front and back, that is, and not a whole lot of documentation required. It's classified as a consumer loan, by the way, even though it is a mortgage, but no, it's pretty easy.
And if someone were interested in that type of loan, who would they call?
They could contact any of our branches and just ask to speak to the branch manager, and they'll be happy to assist them.
Dave, let's talk about reverse mortgages. I'm intrigued by reverse mortgages. We actually had some folks on one of our shows earlier, and I got a little education on reverse mortgages, but a lot of our listeners and viewers are like me. There's a mysterious thing. It's almost like you're getting money for free. How would you describe a reverse mortgage?
A reverse mortgage is a loan product whereby you can pull out equity in your home and have use of that equity while retaining ownership of the home, and yet not have to make a monthly payment. So let's just say, I like to use round numbers. Let's just say, again, you've got a $200,000 house.
Okay.
And you've got a line of credit, a home equity line of credit of $50,000 on it, and you have no other mortgages on it. A requirement for a reverse mortgage is that it has to be in first lien position, and there cannot be any other mortgages. So obviously from the proceeds of that reverse, we would have to be able to pay the mortgage off, and then whatever's left after the closing costs are taken out would be available to you. Now, the interesting part about a reverse mortgage is the amount you can borrow is determined by a formula. There are 3 parts of that formula. Number 1, what is the age of the youngest borrower? Number 2, what is the value of the property? And then number 3, the type of product, which determines the interest rate. And it's literally something that we do through a computer that spits out and tells us exactly what that person can borrow.
Now, I've been told to qualify for a government-backed reverse mortgage, you have to be 62 years of age.
You do. That is an absolute, and that is all borrowers. That's not just a borrower.
Okay. The other thing is it only goes up to 50% of value of the property. Is that true?
No, the older you get, the higher that amount is.
So if you're a 70-year-old man, you may be able to get 60 or 70%. When we're just speaking in general terms.
It does increase as you get older.
Now, I'm told how these really worked is that the government has a insurance that basically backs up the reverse mortgage, and you pay for this insurance. It's access to your loan monthly. Is that correct?
There is both an upfront charge, which you don't pay that out of pocket, but it comes out of your loan proceeds, and there's also a monthly charge. And the purpose of that mortgage insurance premium is it's possible that you could literally live long enough that the loan balance could exceed the value of the property. And that being said, so let's use a scenario again. Let's say you're 65 years old and you have a reverse mortgage for 30 years. You never make a payment. Well, what happens to the interest? The interest gets added back to the principal balance every month, along with the mortgage insurance premium each month. So obviously the loan balance is growing, and in 30 years, it is entirely conceivable that it could be too high. Well, the only way that a lender gets paid is whenever the property is sold. So when the property is sold, if the loan balance exceeds that, the mortgage insurance has to kick in and make up the difference. The key point here is not your estate, not your heirs, and not even your other assets.
So essentially, and let's talk real world situation. You're a senior citizen, you have a very limited family, and you're 65, 70 years old. And when you pass away, your house, you don't know what you're going to do with your house. You may have a cousin somewhere. You can do a reverse mortgage. It can help cover your expenses now, and upon your passing, the house will go to the person, and the difference is the house will have a mortgage on it as if you were buying it. For example, it started out with zero paid. Say your reverse mortgage, put $100,000 on it. The house would have a $100,000 mortgage on it upon your death. It then can be sold, and the proceeds would be split to the heirs. Is that how I'm understanding it?
No, Don, a reverse mortgage maturity event is upon your passing. The property has to be sold, or somebody's got to pay it off.
That's my point.
So if indeed the last borrower passes on, then the home needs to be put on the market at that point in time and sold, the mortgage satisfied.
What are the positives of a reverse mortgage?
Positives are you get to stay in your home and for the rest of your life, as long as it remains your primary residence. In other words, you don't have to worry about being booted out or something like that. You never have a monthly mortgage payment, and so therefore you can stay in your home, maintain your lifestyle, and be able to know that for the rest of your natural life you can remain there.
Now, you still have to pay your taxes and insurance, though.
You do, taxes, insurance, and maintain the property. That's correct.
Okay. To me, one of the biggest misconceptions of reverse mortgages is that you had to go through one of these TV advertisement companies to get a reverse mortgage. And I'm shocked that there's local institutions, especially Citizens First, that will handle it right here locally. What's other misconceptions do you typically run across on reverse mortgages?
Don, we do a reverse mortgage seminar each month at Citizens First Bank. So I hear a lot of the questions of, whenever these folks come in. But here's some common misperceptions. Number one, the bank's going to own my home. They think that whenever they apply for the mortgage, that they're going to have to sign the deed over to the bank. Not so. Okay. You retain ownership of the property. Number two, they're costly. Well, I mentioned earlier about the mortgage insurance premium. That does make them more costly than, shall we say, a forward or conventional loan. But that's an FHA expense, and if you want If the product is right for you, you just have to get comfortable with that. But I think everybody that has a lot of equity, or if you have a mortgage, so that pretty much hits about everybody. When you get older and you want to be able to access the equity in your property, a reverse mortgage can be a good tool to be able to do that.
Now, Dave, one thing I was told by someone else, and tell me if I'm right in this. Say you're a homeowner. Let's take the $200,000 home again. You're 62 years old, and you own a reverse mortgage, but you owe $40,000 to a first mortgage position.
Mm-hmm.
You can actually, I'm told, borrow money and pay the first mortgage position off, and then go to a reverse mortgage, all in the same transaction. Is that true or not?
That is absolutely true.
So essentially, you could go from having a mortgage note every month to not having one and getting money back, correct?
You sure can.
That's amazing.
Well, and another part of one of the reverse mortgage products is that the equity that you do not pull out, in other words, it's part of the balance, the loan amount, but you don't pull it out, that goes into what's called a line of credit. I'm not talking about a home equity line of credit, but as a part of the reverse mortgage, and that actually grows at whatever the current note rate is. And so you could conceivably have that line of credit growing by about 4% every single year. Now, don't send you a check, but your availability of funds grows by that 4% every year.
So it's actually a great product. Now, if someone were interested in a reverse mortgage, who do they contact at Citizens Bank, and how do they contact you?
Contact either myself or Gary Schick, and our number is 352-259-3207.
And I take it's a fairly easy process. I also understand there are credit requirements, but it's not as, the credit requirements are different than a conventional loan. Am I correct in that?
Right. There's no DTI, debt to income analysis that's done. You provide bank statements. You do not provide tax returns. A credit report is pulled, but we will typically get you through the process in 30 to 35 days from the date of application. Now, one of the things that is a requirement, since it's an FHA guaranteed loan, you do have to go to a third-party counselor, and it's usually a 40-minute or 45-minute phone conversation. We'll give you a list of those counselors, and you can contact them, set up an appointment, and all borrowers have to be a part of that counseling session.
And are the reverse mortgage interest rates comparable to regular mortgage rates?
They're usually, like on a fixed rate, for example, they're a little bit higher. That's just standard across the board.
You're listening Around the House, sponsored by Romac Lumber. Our guest today is Dave Van Winkle. He's the first vice president from Citizens First Bank, and we're talking about mortgages. We just have a few more moments. And Dave, there's a lot of landmines out there when someone's approaching to get a home finance, but of all of them, you have appraisals, home inspections, code and city upgrades, income verifications, credit scores. What seems to be the biggest landmines you're seeing, or biggest challenges most potential homeowners are facing these days?
Well, one of the things that has been a real challenge for us as lenders, as well as the borrowers, up to this point has been the appraisals.
Yes.
I mean, we've struggled with that. But I think the good news is that values are starting to come back. You can go even to Lake or Marion County, for example, to the tax rolls and look at the assessment of your property, and you'll see that there's been some appreciation. That's very, very encouraging, because we've had many borrowers who've gone out, put together a deal, only to have the frustration that the appraisal didn't come in to support the sales price.
Are you starting to see those appraisals come back pretty strong these days?
We are. We're very encouraged about that, Don, because that was a real challenge for us. But yes, we are seeing them come back.
And right now is also probably a good time for, just sort of hit me about a reverse mortgage in regard to appraisals, because one of the beauty of the reverse mortgage upon your passing, if the home is valued, if the housing market's low now, it values up in 10 years, that means it's better for your heirs and everyone else, isn't it?
That's exactly right. There's more equity.
All right. How important is home inspections today in the process? A lot of people going out there buying older homes, but there's some big landmines in that too, isn't it?
Yeah, and that can go both ways.
Yeah.
For example, I've seen some home inspection reports that were very, very detailed, shall we say, to the point that there was a lot of money that was required to be spent in order to get the house up to code. And yet there were some things that were probably not necessary, it was kind of an overkill. And so, but what we're seeing is most of our home inspectors out there today, they're trying to do you a good service. They're trying to help you, and they want to make sure that you get a good product. So we've seen a lot of good things come out of home inspections, and usually you can walk away from the closing table knowing that the necessary repairs have been made and you've got a good product.
Dave, in your view, what's the advantages of someone doing business with a community bank like Citizens First Bank over a big national bank?
Well, I personally just like the whole idea of being able to come in and sit down and look at somebody face to face. I just like that, that's a personal preference. But secondly, for example, if you call Citizens First Bank, somebody's going to answer the phone.
That's a wonderful thing. Real quick before we go, we've been talking with Dave Van Winkle, First Vice President of Citizens First Bank. What's the number they can reach you at for questions on anything we discussed today?
352-259-3207.
And we'd like to thank you for joining us today on Around the House. And be sure to tune in every Monday from noon to 1 on WLBE. And once again, thank you, LSTV and Appleseed Marketing. And until next week, we'll see you around the house.